So everybody's doing great, which is awesome to see. Memos are looking really good. If you have problems with like the formatting on the memos and stuff, work with somebody else, get the format over so you're not wasting your time on the format at this point. And then update the memo with your own data and analysis. Okay? So that way we can get beyond the formatting, you can start powering into oil and gold, after the quiz. The homeworks are looking good. Make sure that you use 2 cover pages. You have the cover page templates. You're going to need one for the total deliverable, and you're going to need one for the homework. Okay, when you do the homework and you rip it out of the binder, make sure when you rip it out of the binder that there's not all that frilly stuff on it, and you staple it together. And then make sure also your homework doesn't have like cat paw prints on it and tikka masala or fizzy Coke or whatever. Make sure when you hand in all of these deliverables, they're basically a package that you can show potential employers the type of quality of work that you can do. I know a lot of you don't have work product at this point, so that's part of the class is supposed to do, is help you build a portfolio of work products that you can show a potential employer, if you need to show them stuff. Okay, and then if you can focus, Ronan, and you guys, if you can put your stuff down and just focus on the lectures and stuff. Take lots of notes, obviously. All right, so you should be getting all the videos and everything. The solutions to the homework are on this website. So the problem set, you can practice and just going through the mathematics and learning how to do the stuff, the right way. Okay. Let's quickly do the market updates. And this time I'm not going to wait. You just yell it out. The first one who yells out the answers first wins. Give me the Dow, give me oil prices, give me gold, give me bond yields, give me a dollar to the pound, dollar to the euro, and if you can give me 1 or 2 reasons why it's up or down, you win.
The Dow's up 23.4.
2. To what level?
To what level?
Yeah. 26,000 something.
Yeah, 25,843.
25,843. Any reasons?
Well, there's stocks are bouncing around because the China trade talk and trying to find something to stimulate it.
Awesome. Perfect. Okay, give me oil prices. No,
Oil
somebody else. Just everybody should just yell it out. Be rude. Just talk over people. Give me the numbers. This is a trading room.
It's at 56.6 and it's up 0.03%.
Any reasons?
I don't know, but I saw something about the oil supply might be tightening, so.
Okay, it's either OPEC or something else. Venezuela or Iran. Or, did you have a comment? Okay, give me gold. Or just yell it out. Give me gold. Give me 10-year treasury yield. Give me dollar to the pound, dollar to the euro. Just yell it out. Once you get it. As fast as possible, because we'll run out of time.
Gold is down 0.6 to 1,286.9.
Any reason?
The U.S. dollar remains strong.
Okay, so you go into dollar-denominated assets over gold, which is basically a form of currency too. Okay, next. Dollar, pound, dollar, euro. Or give me a 10-year treasury yield. It's my favorite. Yahoo Finance.
It's 2,000, or sorry,
What's the 10-year treasury yield?
2.724.
Okay, up or down?
Up.
Using the Fisher equation, what would drive nominal interest rates up? No. Use the Fisher equation, what would drive bond yields up?
Higher inflation expectations?
Higher inflation expectations. Okay, excellent. Okay, coursework. I read the pre-test. Everybody looks pretty good. I'm still missing some stuff from some people. Memo 1, those are looking pretty good. Again, if you have formatting issues, get the format from somebody else and update it as your own. Okay, with updated data. Homework number 1, I looked at the draft. Almost everybody was done, which was awesome. You just need to double check your cover page and staple it together to be included in the deliverable. Problem set number 1. I will take partial problem set number 1, just to see that you're working on it, and then after I look at the deliverables and hand back your stuff, if you handed in the problem set and you only made it halfway through or didn't do it at all, I'll give you extra credit when you hand back the deliverable after I give it back to you to remediate any of the deficiencies within the deliverable that you handed in. Does that make sense? Do you understand?
Is problem set 1, is that the extra credit one?
Yeah, that's
Okay.
that big. I'm saying if you want to make an attempt at it, make an attempt, stick it in there, just so that I know that you're working on it. And then when I give you back your deliverable with the comments and everything, when you resubmit the deliverable to get your A, then if you want, you could resubmit the problem set to get the extra credit and nail down your placement costs. Okay? And then give me a resume. If you want to show me the resume on Thursday, I'll take a quick look at it. You should be working with Mary Beth to get your resume done because you need it. Okay? And I want to take a look at it too. And if you don't have a resume, you don't have any work experience, you need to work with me and Mary Beth with manufacturing experience and get yourself a resume that you can use to start distributing for your internship for this summer, or your job on graduation next year. The quiz is going to be 2 days, on Tuesday, Thursday, March 12th and 14th. You will come in, you will, on Tuesday, you'll put all your stuff on the floor except the calculator, and I'll give you a fresh quiz and a fresh blue book. You'll go at it, and then when you're done, you can give me that back, the blue book and the quiz. You're going to go do what you need to do to study and remediate what you forgot or what you want to augment and add to some of the questions. You come back on Thursday, you finish up the exam, and you give me the deliverable. Okay, and then I'll take all the deliverables and I'll sit down with my TAs and we'll go through it and we'll give you some comments and stuff like that. Okay, is everybody clear? And then in Galileo on the 3rd floor, I'm gonna take over the conference room on Friday and Monday from 12 to 2 and do a review session. Okay, if you want to come in and see me on a Friday or Monday from like 8 to 9 or in the morning, just text me, let me know. And let me know if you're interested in these review sessions. Sometimes they're extremely popular. Other semesters, sometimes I get a half a dozen, sometimes I get like 20 people. So let me know so I can gauge the demand if I need to get a classroom or something. Yeah.
So just to clarify for the quiz, we're doing it on Tuesday
And Thursday.
and Thursday, but we don't get to take the quiz home,
No.
and we don't get it back to redo.
No.
Okay, so
You have to remember where your deficiencies are.
okay,
So you come in, you take it, and then you give it to me.
Okay.
So I have it. Then you go study. Okay. And then you're going to come back on Thursday. I give it back to you, and then you finish it.
okay.
So it's a 2-part exam.
Will it be the same questions on Thursday that were asked on Tuesday?
Yeah, unless you want me to develop some new questions and change it up.
Okay, no, that's fine.
You want like 50 multiple? I hear 50 multiple choice questions.
Sure, if you want us to take it home.
I don't think you want to do my multiple choice exams. Yes.
For the review sessions,
Yeah.
if we're not able to make it to those times, are you gonna record them before you do your
Yeah.
comments and send it to us?
Yeah, just make sure if you do come that you remind me. Sometimes I forget to bring my camera, but usually I do the review sessions and I do record it and I try to post it as soon as possible to get you the content that you need to study. Okay, you're welcome. Anybody else? Okay, so on Thursday, March 14th is going to be when the deliverable 1 is due. Okay. So what is deliverable 1? Well, 1, you're going to have the cover page. Okay. Everything's going to be clipped together with one of those bowl clips. You know those bowl clips? Yeah. Don't use paper clips or anything. Make sure everything is put together nicely in the package with the cover and the clip. Because I look at it as one package, but also individual deliverable components. Okay. And my TAs have been, trained in grading these things. We've gone through hundreds of these, so they're really good at looking through them and giving you some suggestions of where you need to go back and spend a little bit more time, maybe review the videos, afterwards, that kind of stuff. So we'll go through and grade everything, whatever's missing, I'll give it back to you, and that's all you have to do is remediate the stuff that's missing stuff. Rehand that in, and then you get a full grade. So there's no reason everybody shouldn't get a good grade on this, okay, unless you're just, you know, blown out or tired or something's come up. So then after the cover page, you're gonna have the first memo, then you're gonna have I'm gonna insert the in-class quiz blue book, and then the class notes and quiz notes in the blue books. There's 2 blue books, and if you've taken notes in a binder, you can also always just rip out those notes and stick them in a blue book, and then give you the blue book as the notes, because that's the way we see it. Okay. And then next is homework 1 with the cover page, staple together and handwrite the solutions, because again, you will learn more when you're writing them out. You learn the math and stuff like that. Okay. And you'll learn how to do it the right way. And then you'll give me the problem set 1. Okay. Partial, don't give it to me if it's blank. And then the statistical pretest, and then the resume. Okay. And then that all gets delivered to me. Okay, at the end of the class. If you guys some of you are having problems or issues or anything, just let me know, work with me, and we'll work around any obstacles or issues that you may have, okay? If you need more time or something, or your family, or dog, or mom, or something, just let me know so that we can communicate, and I can manage the situation, okay? Any questions? So let's just kind of go through the pretest is done, so the quiz. So let's kind of audit what we've gone over and what we need to accomplish. So we've already gone through the macroeconomic foundations and the unorthodox monetary policy. The balance sheet is brought out by the Fed. We've never been here before. 4.3 trillion balance sheet, 4.3 bank reserves. 2.5 billion are government treasury securities. The other half is for mortgage-backed securities. Why has the Fed not been able to grow GDP at target 3% or get inflation at 2%? Is because the velocity money has collapsed. Okay? And the velocity has popped up, and now we're hitting the inflation targets and we're hitting GDP targets, although GDP looks like it's starting to slow. So it'll be interesting to see if the Fed raises interest rates or starts to increase the money supply or stop unwinding the balance sheet. So that's basically the unorthodox monetary policy. We also studied yield curve dynamics and the dynamic of yield curve. So we looked at the yield curve, the maturity of the securities, interest rates, upward sloping curve, normal curve, using the Fisher equation, inflation expectations under a normal curve and positive, a flat yield curve, the inflation expectations are 0, and in an inverted curve, the inflation expectations are negative. We looked at the different yield curve theories, expectations hypothesis, preferred habitat, market segmentation, liquidity preference. We talked about those. We talked about the relationship between the dynamic yield curve and the S&P 500, and we noticed through our research that when the curve inverts, the stock market peaks in less than 12 months, and we're in a recession in less than 24. The economic indicators and targets are basically the market updates. I'm looking for that table there that gives me the asset class, the level, or the index level, the price level, or the index level, either a percent or point change. Is it up or down? Is it up or down in the short term or the long term? And then give me some reasons why it's up or down. I'm just testing you to see if you're tracking the markets and you understand the economic and financial factors that would drive these indexes and the prices up and down. We went through last week the dynamic supply-demand analysis. We looked at the supply shocks, with negative and positive. We looked at demand shocks, positive and negative. We looked at the factors that would shift the supply curve back and out and demand curve up and down. We went through stocks, oil, gold, and we're going to finish bonds and U.S. dollar and foreign currency today. Okay. These, again, is the intellectual infrastructure or your operating program that's in your brain when you're writing your memos and when you're analyzing the markets. Okay? These are the fundamentals, and these factors are the factors that you could be using as the 3 factors within your memos. Okay? Everything's related. Today I'm going to go through the microeconomic foundations of financial product innovation, engineering, digital media, and marketing. People love and management, and love this lecture because it's basically a capstone. Okay, do you know what the capstone course is that you take? Do you know when you take the capstone course? The last course in your business program in the last semester. This lecture is basically the capstone. Okay, so I'm going to do a capstone around financial product innovation. There's no difference between the factors that drive financial product innovation and technology innovation or any other process of product innovation. It's all, the criteria is all the same. So this basically is a mini lecture of your capstone. So you're getting it now in your junior year, which would be great when you go do your senior year. If you have this intellectual infrastructure in your brain going into your last year, you're going to get way more out of it instead of waiting to like the last semester, the spring, right, of 20, to get through some of this stuff. Okay. And I invented this lecture because I was told by some people in corporate, in the real world, that our students don't understand product innovation or the sales cycle, and that needs to be brought into the classroom. And it was the same thing with the memos. They said your students can't write, business quality memos. So I brought those 2 in to check off that box. Then, if we get through today, modern portfolio theory and postmodern portfolio theory. Derivative trades, there's 2 sets. I'll go over those. We've already gone over them with the introduction to the memo, and we'll go over them again. I'll try to do the derivative definitions and also the technical securities analysis. The finance problems on the exam, I'll try to get to 2, but I've already given you the solutions. So it's just a matter of just walking through them. I'll try to walk you through the solutions. I got them there. They're pretty straightforward, except for maybe the bond questions a little bit hard, but the other ones are just straight discounted cash flow analyses. And then we already went over the model building and forecasting for the exam. Any questions before I get started? No? Okay. I would take good notes on this stuff. If I were to take pictures of all this stuff.
Are these notes going in the blue book?
This is for the extra credit. This is the exam. Okay. So if you do a good job and take good notes, then it becomes a really solid study guide. And then I did make, if you wanted to take some pictures, I can pass around a couple of these. I took some notes on some stuff, so if you want to take pictures of these, it's just some backup notes for you to have, to refer to and to study from. Again, I'm not testing you on the exam what you don't know, I'm testing you on what you know. So I'm giving you all the resources you need to be able to study the stuff that's going to be relevant. Okay? No tricks, no gimmicks. No tricks, no gimmicks. Okay? I believe in total transparency. Anything other than total transparency is just a waste of time, in my view. So let's do the supply-demand analysis. So I'm looking for something like this. Is the first thing I look for in the exam. I'm looking for the supply side and the demand side. So you're going to start with the system in equilibrium. So you have your supply curve, your demand curve. Here's the equilibrium point. Here's equilibrium quantity supplied. And here's the market clearing price right there. The curve's going to shift back. That's a negative supply shock. Where it's going to shift out, that's a positive supply shock. When it shifts back, the quantity supplied shifts back, and the prices rise. When you have a positive supply shock, the supply curve shifts out, quantity supplied shifts out, and prices fall. On the demand side, again, you start with the same thing. Supply curve, demand curve. quantity demanded in equilibrium and market clearing price. When the demand curve shifts up, quantity demanded shifts out, and the price goes up. When the demand curve shifts down, quantity demanded shifts down, and the price drops. This should all be reinforcement or review from your microeconomics class. Okay. But it's more specific to the financial assets. So what would cause the supply curve to shift out for bonds? Remember we did the other three, now we're just finishing up bonds in the US dollar. So what would cause the supply curve to shift back for bonds? One would be a budget surplus. It's only really occurred maybe 2 times in post-World War II. The last one was under the Clinton administration. So when you run a budget surplus, you have a lot of tax revenue sitting around, and you can take that money and you can expire the debt. You can go into the government debt market, you can start buying up securities, and you can basically put them to rest and put them away. You can start paying off the debt. The other is, which would be called bond buybacks. The other is you let the bonds roll off, you let them mature, pay the premium to the investors, you let them roll off the balance sheet, and you don't replace them. Okay? That would be another way that the supply curve to shift. What would cause the supply curve to shift out? Structural budget deficits. You don't have enough tax revenues coming in to basically meet all the budget expenditures. So you're going to need to raise money in the marketplace. If there's not enough demand for those bonds in the marketplace, then it's going to shift out the supply curve. Quantity supply is going to increase. Prices are going to fall. And when bond prices fall, what happens to interest rates? They go up. Okay, exactly. The other is you have the Federal Reserve selling bonds, and you have foreigners selling off their bond holdings. If there's not enough demand, the supply curve shifts out, quantity supply shift out, prices go down, interest rates go up. So you can have a sell-off of those bonds by the Fed and by foreigners. And those have all occurred over the last 2 years. What would cause the demand curve to shift up for bonds? Well, the expectations of lower inflation expectations, falling interest rates, Federal Reserve, and foreigners buying the bonds will cause the demand curve to go up. Lower inflation expectations will also cause increasing demand for bonds. Disinflation, falling commodity prices, falling inflation expectations, and then low and falling stock and real estate prices, or low and falling returns on stock and real estate. So if I think the stock market is peaked, the real estate market's peaked out, we're going into a recession, I'm not buying real estate, I'm not buying stocks, I'm buying bonds, because I'm scared. We're going to go into a recession, and that'll increase the demand for the bonds, increase the prices, and drive down interest rates. What would cause the demand curve to shift down for bonds? Well, if you know one side, you can flip it. You can flip it. So higher expected, higher expected stock and real estate returns. Why would I buy bonds, which are lower yielding but highly liquid? Why would I buy bonds at a lower yield when I think the stock and the real estate market are going to go up? I'm selling off my bonds and I'm buying real estate and stocks. Okay? So the demand curve is going to shift down because of lower, higher stock and real estate prices. Rising inflation expectations and interest rates. As inflation expectations go up, interest rates go up, and bond prices go down, why would I be buying bonds? I wouldn't. I'd be losing money. So as inflation expectations go up, interest rates go up, and bond prices go down, the demand curve will shift down because people aren't going to buy bonds in a rising inflation or interest rate environment. And then a higher gross domestic product, higher growth rates in the economy. If the economy is overheating, then inflation expectations are rising, interest rates are rising, and bond prices are falling. I'm not buying bonds, okay, if the economy is overheating. So those are the factors. And again, you can use these factors in your memos. Okay? And you may even find other factors as you do your research. for the US dollar, when you go to the dollar, you're not coming up with the price of the dollar, you're coming up with the value of the dollar, okay? So it switches. So all the other asset classes are prices. When you get to the dollar, it's valuations, it's value, okay? So what would cause the supply curve for the dollar to shift back? I came up with slowing or low money supply growth rates. The Fed and the Treasury are restricting the amount of supply of dollars that are being put into the marketplace, and there's a shortage of dollars. Governments and individuals hoarding dollars for precautionary purposes or to hold as reserve for future dollar-denominated liabilities. Okay. Low interest rates and inflation. Again, people aren't going to buy. The supply curve is going to shift back for the dollar when you have low interest rates and inflation. Low interest rates. Why would I buy the dollar if interest rates are low in the United States but higher someplace else? So I'm going to want to sell off the dollar and then buy foreign currency. So low interest rates could also cause the supply curve to shift back. What would cause the supply curve to shift out? High money supply growth rate and the Treasury buying securities. Selling the dollars by foreigners. So for some reason, foreigners want to be out of dollars, they need foreign currency, they want to sell off their dollars, and that would also push out the supply curve. On the demand side, what would cause the demand curve for dollars to go up and the value to go up? Let's take a break here for a second. When the values go up for the US dollar, it's called two things, either revaluation or appreciation. Okay? Revaluation or appreciation. It's revaluation revaluation is when the government basically intervenes in the currency market and causes the values to go up. Appreciation is when the market forces drive the values up. Okay? On the opposite side, devaluation is when the Treasury and the Fed intervenes in the currency market and causes the dollar to devalue. If it's market forces, it's depreciation. Okay? So when you get higher values, it's either revaluation or appreciation. When the values go down, it's either devaluation or depreciation. Okay? All right. So what would cause the demand curve over the long run to shift up in the dollar to appreciate? One would be higher labor productivity rates. Higher labor productivity. Again, if you have higher labor productivity, the corporations and the companies have higher profit margins. And people are going to flow into the United States and increase the demand and cause the dollar to appreciate. Higher return expectations on stocks and bonds, or stocks and real estate, and also interest rates. So I think that dollar-denominated assets, such as stocks and real estate, are going to give me a higher rate of return compared to other investments in stocks and bonds on a global basis. And if the United States is offering a higher interest rate on the bonds compared to other government bonds, then people are going to sell off their foreign currency. They're going to buy the US, convert into the US dollar, and buy American denominated assets. And that's going to cause the dollar to appreciate. Okay? So higher labor productivity, higher expected returns on stocks and real estate, higher interest rates, low inflation expectations. If the inflation rate in the United States is lower than other foreign countries, then people are going to invest in the dollar because the dollar's not deteriorating as quickly under low inflation rates. So what would you rather be in, the Venezuelan peso or the American dollar in regards to inflation? 1,000,000% inflation, or basically 5 to 8% inflation. I'll take the 5 to 8 any day over the 1,000,000%. And then you can just flip these. What would would cause the demand curve to shift down for the US dollar. Low labor productivity, low expected returns, low interest rates, those would be the factors. You may find other factors as you do your research, but these are the factors that I came up with. That would shift the supply and demand. Any questions? No? Yes? Okay. Let's do the financial product innovation and financial engineering. When you go work for, how many people want to go work for a company? How many people are going to have their own company? Okay. You're going to have to build product. You're going to have to build process. You're going to have to innovate. I mean, all the top companies within their sectors, in their space, basically now are building companies that basically allow for product and process innovation. You're going to go work for a company, you're going to be working on projects. You may be involved in product development. You may be involved in process development within the firm. It's all the same thing. Product development, process development. As you move up within the company, you're going to be overseeing the product and the process development. You're going to be overseeing teams of individuals. You're going to be managing teams of individuals that are inventing and innovating products and processes. If you work your way up to an executive level position within the company, you're not managing just one product or one process. You're managing multiple processes and multiple products. Therefore, you become a program manager, managing a portfolio of products and processes. That's where you want to be. Okay? That's where you want to go. So, to be able to create an environment of innovation and product innovation, companies need to meet certain criteria to be able to build a culture of innovation and change. Okay? And it's really hard to do. So how do you develop a culture for innovation? And I just happen to use financial innovation, because derivative contracts is a financially engineered product. Insurance products, annuities, exchange traded funds, stocks, bonds, they're all engineered products. Okay? No different than an iPhone or a software application. It's the same thing. Finance is just a technology that innovates product and processes. So if you look at the top finance firms, and just the top finance firms in general, this is how they're thinking. This is what they focus on. So the first thing they focus on is a constant environmental scan. They're constantly looking at the marketplace, anticipating changes either in the market or regulatory changes that are coming down by government. So they have to be prepared. And they have to be able to implement change management strategies. They got to be adaptable. They can't be myopic. They can't have organizational structures that are stale or misaligned with the marketplace, because the stock prices are going to be affected, the revenues are going to be affected, and if they don't change fast enough, then they're probably going to get taken out by a competitor, or they're going to go bankrupt, one of the two. So one of the biggest changes out there that shock most industries and companies is regulatory changes. So if you look at the finance industry, financial services, you look at before the financial crisis, before Dodd-Frank, you look before the financial crisis, the organizational structures of these firms were very different. They were very trade-oriented, they were speculative firms, they were into deals and underwriting. It was more of a trader's type of structure. After Dodd-Frank was implemented, they restructured the industry. They became asset management companies, risk management companies, and investment management companies. Just the models changed a lot. Then there's also competitive pressures. Finance and technology, extreme competition from competitors. Right now, fintech is pressuring changes in banking and central banking and the way people actually engage in transactions and money and finance. So very disruptive. So competitive pressures and regulatory changes. Inside the firm, there's an industrial psychology within the firm. Industrial psychology. There's a sociology within the firm. There's individual and group psychologies and dynamics, and there's individual and group leadership styles within the firm. We all work together in these firms. Senior level executives are models for us that we emulate their attributes. We try to emulate the attributes through a self-efficacy process, And if we can do it correctly, we can be very successful. But if the managers are exuding abnormal behavior and we're adopting abnormal behavior or ethical or moral behavior, it could come back to divide us. You have to look at the organizational structure of the firm, and you need to align the organizational structure of the firm with the marketplace constantly. At some point in time, the organizational structure of the firm is myopic. There's dissonance between the market and the org structure, and the company needs to be restructured to bring it back in alignment with the marketplace. So the org structure has to have market alignment. You need to be able to change. You need to redesign the firm. You need to restructure the firm. That takes a lot of courage to be able to do that. You need cultural leadership at the team level, because again, the team leaders and the corporate executives are going to be the models for all of us, and we're going to be emulating their communications, and we're going to be emulating their behavior. There needs to be clear strategy, clear tactics, clear operational goals and objectives, not only to the stakeholders, the stockholders, and the employees. I think that's where a lot of companies make their mistakes. They're too opaque. They're not transparent enough. And you need to be able to set out achievable metrics that you can achieve within the short and the long run, and you need to benchmark yourself against your competitors and benchmark yourself internally to know that you're on track or you're off track, so that you can recalibrate to get back on track and stay focused. So the strategy, the tactics, the goals, objectives, the metrics need to be clearly communicated to everybody within the firm and outside the firm. Product and process innovation, program innovation, product innovation, process innovation. To be able to innovate, these firms, the way that they innovate is they look back and they basically document all of the knowledge and all of their intellectual property and all their experiences into an enterprise resource planning system, into some kind of knowledge database, so that they're confronted with an environmental change and they need to create product quickly. They can go to the knowledge database, pull up examples and case studies and use cases of products that have been built before in the past, find the teams that were successful at building that product, reassemble the team to basically build a new product to basically solve the problem very quickly, and know that all the resources that are necessary to do it. To be successful at this, you need to be able to recognize the market wants and the market needs. For example, when I worked at New York Life Insurance in 2010, coming out of the financial crisis, the customers and the stockholders, the stakeholders, the policy owners, and the customers were screaming at senior management to invent guaranteed products for them as investments, because they were watching their portfolios in 2008 and 2009 drop by 30 to 50%, in the worst case scenario, 70%. And they said, we do not want to go through this again. Invent us guaranteed products. And within less than 6 months, they built 2 guaranteed annuity products that allowed customers and investors to put their money into these products, guaranteed that they would lose no money from market exposure within 6 months. And they were able to capture over 50% of the market within that first 6 months. And today, after after 9 years, almost 10 years, they still own 40% of the guaranteed annuity market in that space. And this was a 167-year-old firm that was able to respond to the market very quickly, develop the product, get it to market, and capture market share, and lock those customers in forever. So you need to be able to recognize the market wants and the market needs, and then respond. You need to be able to build and develop the product. To be able to do product development or process or program development, you need an ongoing research and development arm within the company. You need a group of individuals that can build the product very quickly, that are constantly listening to the customers, constantly monitoring the market. They see an opportunity, they build and design the product, they test it, they bring it to market very quickly. The product, when it's developed, has to have attributes that solves the customer's or the market's problem. In New York's Life case, it's we don't want to lose any money in our stock portfolios ever again. Build this guaranteed product. That was the attribute, not losing any money. Once you've designed the product, you gotta manufacture it. It's gotta be standardized so that it can be scaled and distributed very efficiently across your distribution networks. So the program, the product, the process, manufacturing, it's gotta be standardized, and then it's gotta be distributed through your distribution channels. Schwab, JP Morgan, Goldman Sachs, B of A, Wells Fargo, they all have very efficient distribution channels through their branch networks and their affiliated registered investment advisory network. If you don't have existing distribution networks in your portfolio, you need to buy it or you need to build it, okay? But if the product is too expensive to buy and build, the distribution channels and to buy and build it, you're not gonna build it. You can't buy it, you can't afford it. But if you don't have it, you don't have the existing, and you're a big company like JP Morgan does, you're either gonna build it or buy it, whichever's cheaper and most effective. Once you look at the distribution channels that you have available to you, you're gonna have to optimize to figure what distribution channels we wanna use in proportion that's gonna maximize revenue growth and is going to maximize and generate the most revenue for us. So you gotta be able to look at your, not only your distribution optimization, but the networks that you have available to distribute through, and then optimize the mix of those distribution channels, again, to maximize revenue and revenue growth at the end of the day. You also have to look at and analyze your supplier network and look at your supply chains. And you're gonna have to manage your supply chains, manage the supply chain networks, and come up with the optimal mix of your supply chain. If you put too much concentration in one supplier, if the supplier goes bankrupt, then you disrupt your supply chain, and it's going to disrupt your distribution, and it's going to impair your revenue growth and your profitability. The next is, which is really important, once you've done all that, then there's business development. You got to go out and find the business, develop the business, either at the retail level with individual investors or at the institutional level through investment advisors or institutional investors. Once you've done the business development, then you have to come up with the marketing plans. You got to come up with the advertising strategies. You have to sell into the marketplace to generate the revenue and the revenue growth for profitability, for payback, for all of it. On the marketing side, you have to do the market segmentation and then optimize across the market segmentation. Market segmentation is, I'm going to be building different products for different segments of the market. Businesses versus individuals, businesses versus high net worth individuals, businesses versus institutional investors. Investors that are between the ages of 70 and 80 years old, between 50 and 70, between 30 and 50. Segmentation, you're going to have to do the marketing research with your data analytics to be able to figure out what the segments of the market are, which ones you want to target that has the biggest opportunity, what products are you going to sell into those segments, and you have to design new products to sell into those segments based on the opportunity. So when you're doing market segmentation, you're then going to identify the markets you're going to sell into. Once you've identified it, you're going to sell into those markets. The markets are going to be targeted and segmented by either psychographics, culture, style, fashion, age, demographics, age, income, race, economic and industry segments. Am I going to be selling into the manufacturing industry, or am I selling to the clothing industry? What are the segments that you're going to be selling into? And then what size of company? Am I selling to large corporations, mid-sized companies, or do I see more opportunity selling into small companies? You have to determine all of those factors. Then once you've identified the target markets, then you put together the advertising campaigns. Anybody ever heard of Charles Schwab? Ask Chuck. You ever heard of that campaign? Ask Chuck was an extremely successful marketing campaign for Charles Schwab. It was so successful that at the time they launched that Ask Chuck campaign, they were launching mutual funds at the same time. When I was there, they launched a mutual fund, an all equity stock portfolio. They launched the fund on a Friday, and by Monday, they had $2 billion under management within the fund, because they had all of these criteria, the distribution channels, and the marketing was so powerful. So the advertising campaigns are important. In financial services, we're targeting fee generation. Okay? How do we generate fees? When I sell an insurance policy, I make a fee. If I'm selling annuities, I make a fee. If I'm managing assets, I'm making a fee on assets under management. So what we're trying to do is to sell as many products as we can to generate fee revenue and to get as much assets under management, or what are called AUM, to be able to charge a management fee to generate fee revenue. That's the goal. How do you prospect clients? This is extremely important. Once you've done all the identification and targeting, you're going to have to reach out through the advertising campaigns to be able to prospect clients to get them engaged with you. And you're going to have to take these clients through the sales cycle. Okay, I identified some prospects, I call up the prospects, I email the prospects, I text the prospects, whatever the communication channel is. I get to the prospect, we have an initial conversation about their interest. I basically qualify the prospect by asking them a bunch of questions. Then I ask them questions until I find what their hot buttons are, where the risks or the returns, where they want to be. I basically go back, I design the solution, I come back to the client, I present the solution. If the client accepts the solution, then I move forward on closing the transaction. And if the client rejects or has objections to the sale or the product, I have to overcome those objections to try to drive them to the sale. You're all going to be in sales, okay? Doesn't matter what you do, you're going to be in sales no matter what. I thought I was going to be in finance and economics all my life. I found out that I was working for Schwab's marketing department. I moved on and worked for New York Life, became one of their marketing. You're going to go into sales no matter what. That's where the opportunities are. So you got to be able to prospect the clients. You got to move them through the sales cycle as quickly as possible. You need conversion rates. How many prospects I go through? How long does it take me to convert? Conversion is really expensive. It takes a lot of time, a lot of touches. Financial products are intangible. They're not like an iPhone, which is totally tangible. I got it physical, I can put it in my hand, I can look at it, I can email, I can text, I can social networks, I can work in Microsoft Office, I can talk to people, I can take pictures. These are all tangible attributes. Financial services are intangible. It's the hardest product to sell that I know about there. Once you've taken the client through the sales cycle, you now have locked them in to the product. That's why we keep buying these iPhones. That's why we keep upgrading to Microsoft Office 365. They got us locked in. When we come out with a new product, we can basically resell them and lock them in for a recurring revenue stream. Financial services is exactly the same. And if you can lock in these clients, you got a perpetual and recurring revenue stream that's coming in. That's huge. All companies work in this fashion. Then if you can move the client through the sales cycle and you can create velocity in the sales cycle so you can close faster, and if you can increase the velocity through the cycle and then scale your deals, profitability will be extremely huge. So for example, I got 10 clients, they all want $1 million worth of life insurance. It's going to take me 2 months, each client, to basically close each one of those transactions. There's no difference in amount of time for me to underwrite and write a $10 million life insurance policy or $1 million life insurance policy. So why don't I focus on closing $10 million life insurance policies as opposed to 10 $1 million life insurance policies. Now I've gone through the cycle, I've increased the velocity and the conversions, and now I am increasing the scale of the transaction to generate more profitability. Also, once I've locked these clients in, I can upsell them to higher quality products, and I can cross-sell them to other products across the product line. So I basically got it. Then you need customer service. You're gonna have to constantly stay in contact with your clients on an ongoing basis. You gotta build a customer relationship with these clients. You gotta build a relationship. They are not gonna buy anything from you. They're not gonna do business with you in any way whatsoever if they don't like you, if you can't communicate. If your company has brand or product damage, they're not doing business with you. Okay? So you need to be able to build that relationship. And you need to be able to track all of your clients within a customer relationship management system in a CRM. Are you exposed to CRM applications? Do you use CRMs in your marketing classes? Are they teaching you Salesforce, or Microsoft or some other CRM application? Then how do you track your clients if you don't have a CRM system? You gotta be able to put all of the customer information in there. You need to toggle and tickle you and them on an automated basis. You need to get on the phone with them. You need to send emails. You're gonna need to stay in constant contact with these customers, because if you don't, they're gonna fire you and go to somebody else that's gonna give them the customer service. So you gotta have the client relationships. You gotta follow up, and you gotta retain them. You gotta cross and upsell and take opportunities. Lastly, you need customer and market feedback. Okay? This is a feedback loop. It all starts all over again when you're talking to your clients, and your clients are telling you that they need new products that have new attributes, and your old products have defects in it, and that you need to go back and refine your products and bring them back to market to resell them to us and fix some of the things. And you need to satisfy the wants and the needs of the client and the market. You need to solve their personal and market problems, and you need to be able to bring those products to market as quickly as possible to gain market share and to generate revenue. If you can do that, your company will be extremely successful. There are two ways of looking at this. There's the operations research model, which are S-curves, or the product adoption cycles. You've been exposed to S-curves or product adoption cycles? Have you been exposed to product adoption cycles or S-curves? Have you?
Yeah.
Oh, awesome. Is everybody familiar with the concepts?
Can we just go over it?
Yeah. It's extremely important because this is the way the market speaks. Okay, so there's two ways of looking at it. I got a company that basically invents technology, a process or product continuously over time. Okay, IBM, Salesforce, Cisco, Intel, they're all technology companies. They all invent product. They all invent technologies. So the S-curves look like this, and this is where all the students make their mistakes. The S-curves look like that. And the S-curves are tangent to each other. So a successful company will continuously invent new technologies, contiguously, consistently, over time, and be successful at it. If they can be successful at continually developing new products and new technologies over time, what happens is it develops, the market gives it a path. This line right here is the revenue growth path. So the market will assume that you can continue to develop these technologies over time and generate constant revenue forever. If you take this and put it into the model, what it assumes is your cash flows out into infinity forever is divided by your cost of capital minus the growth rate maximization in these cash flows. So the goal is cash flow growth maximization through ongoing technology development successfully. If I can maximize the growth rate, I'm going to maximize the value of the firm. If I can't maximize the growth rate, then the value of the company is going to be impacted So that's the S-curve, okay, approach. Product adoption cycle from your marketing. You need to be able to move through the product adoption cycle very quickly. You first start off in the innovator stage where only the innovators are adopting your product. It's the early movers, the first movers on the product. Then, if you're lucky, you're going to move into the early majority adoption phase, where it's going to scale very rapidly. And this happens very quickly these days due to the network environment in which we operate, due to social media and other forms of network technologies. So this hockey stick is where your revenues and your cost structures are increasing very rapidly. This is where these are the two phases where most companies fail, okay? Because they burn through their cash and they go bankrupt. Or they move into the early adoption phase, early majority adoption, into this hockey stick phase. But the founders of the company don't have the intellectual capabilities or the experience in managing hypergrowth within their companies. And they're unwilling to give up the control of the companies, so they end up taking the company out because they make too many mistakes because they've never worked in a startup environment before. Once the product is completely adopted or goes from early majority adoption, it moves into majority adoption where everybody has adopted it within your market space. Then the revenues and the adoption starts to decline into late majority and then into the laggard phase. So the goal of all successful companies is not only continuous technological innovation, but continuous product innovation, so that once they've gotten through this early majority, they're already developing their new product, developing their new products. So they also create this upward revenue growth expectations curve by the market, and if the market knows that you can deliver product consistently over time, then you're going to maximize the growth rate of the cash flows and maximize the value of the firm. So those are the two models that you'll hear a lot about. You'll hear them in meetings. You'll hear them in when people write articles and they're doing analysis about these companies. Okay, the last two are financial feasibility. If I'm going to develop a product in a process, I got to know how much it's going to cost. And I got to be able to project out what the revenues are going to be in the future. If it's going to cost me too much, and it's not going to recoup all of our money in less than 3 years, we're not going to do it. We can't do it. If it's too expensive, then we can't execute on it. So you have to do a feasibility analysis. I worked with Schwab at the time. We were bringing products to Schwab's product line group. First thing we would do is we would do the analysis, figure out the projected cash flows and the revenues from the product, net of expenses, figure out the break even. We would conduct capital budgeting, and we would look at the present value of the cash flows, we would look at the net present value of the cash flows, we would look at the internal rate of return on the product, and we would look at the break even and how long it would take for us to reach break even. These are the decision-making metrics. You're going to learn this in capital budgeting section or during the midterm part of the class. These are the metrics that we use to make investment decisions in regards to innovating new products and processes. The last is, how do you enter a market, and decide to build a product? How do you decide to exit a market? It's got to be rules-based. You have to have unbiased rules using all of the metrics that you design to basically tell you we've monitored the market, it's met the majority of our criteria, we should allocate the capital, we should enter the marketplace, develop the product, and move into the marketplace. So rules-based, not gut feels and not based on politics. When you get into the corporate world, there's going to be a lot of gut feel around you, unless you're working with engineers. And there could be political dynamics within the company that could pressure you to basically develop a product and bring it to market when the product should not have been brought to market. It was flawed. It was a flawed product, or it didn't meet the economic criteria to do it. You have to have solid metrics, and you have to have solid benchmarks, not only to enter the market, but also exit. for example, Gap Inc. the other day decided to spin off Old Navy that they had in their portfolio for years. Why did Gap Inc. spin off Old Navy? Well, because it wasn't adding value to the parent company, and they could spin off Old Navy into the marketplace as a standalone company and arbitrage the value, because the Old Navy was worth more in the marketplace than it was internal to the parent company. I thought that was just a brilliant, and I'm sure they went through, they were monitoring the situation, they had solid metrics and benchmarks, it was rules-based, and they said at some point, we spin off the company. Any questions with that? Okay, how much time do I have?
15.
15? Okay, 15? 15, okay. Let's do the derivative trades, and then I'll do the technical securities analysis, and I'll save the portfolio for last, and then we should be done with the pre-test except for the problems. So when you're analyzing stocks, there's two methods in valuing stocks, in analyzing stocks. One is the fundamental approach, which is your perpetuity model, Gordon growth, multiple approach, and discounted cash flow. Those are four intrinsic valuation methodologies when you're analyzing stocks. The other is technical securities analysis, where you're actually looking at charts, and looking at patterns, and you're looking at trends. The book doesn't talk about technical securities analysis. When you go work for a company and you go analyze the sales patterns, and you go analyze revenue patterns, and you go analyze your stock chart, they're going to print out graphs for you. Are you going to be doing graphs showing timelines and time series and history of sales and revenue and conversions? And are you going to be looking at any of that stuff? You know, financial time series, are you going to be looking at history? That's what technical analysis is, okay? You're looking at patterns, trying to identify patterns, and then trying to act and react based on those patterns, okay? So there are different types of techniques, technical analysis techniques. Momentum trading. The assumption is that the stock price has been moving up, you know, over a long period of time. The probability the stock price is probably going to continue to go up because there's momentum and there's trading volume. So you're looking at historical prices. You're looking at price behavior. Is there recurring patterns in the data? Do some industries go through seasonal patterns, which is retail, seasonal, weekly, monthly, quarterly, annual? So you have to take those into consideration. You're going to be using time series analysis, maybe using regression to try to forecast these stock prices. You're looking at trading volume. Trading volumes on the stocks, trading volumes go up, stock prices go up. More buys than sells. Trading volume, when trading volume goes up, sometimes there's more selling in the stock, so the stock prices go down. So trading volume actually gives you an indication if the stock price is moving up or down. Did I show you the moving average crossover system? The 10, the 30, the 50-day? You know, when you have a 50-day, when the 10-day crosses, that's the buy alert, and then when the 30-day crosses, we didn't do that. Okay, that's the buy signal. So you could be using these moving averages of the prices to be able to trade the stock and look for momentum. There are things called wedge and flag patterns. Flag patterns look like this. So the stock price could move in a pattern like that, or it could, okay, that's the flag. There's your flag. And there's your wedge. So price patterns. There's also channels. Trading channels where the stock price is going like this. So it's moving up and down, but it's moving up in an upward trend. There's also called the head and shoulders. I'll show you those. These are all the techniques. There's also what is called a Wyckoff method, which is very sophisticated. You can also use what is called the MACD and the RSI. We'll be using that later. You can be using sentiment indexes. There's also Dow theory. And there's others. If you're trading currencies, you use a lot of technical analysis. If you're trading stocks, you use technical analysis. So basically, there's the fundamental analysis, which is what we've been looking at, and then there's technical analysis. It at least deems an honorary mention, since this is a finance class. So let's do a hypothetical chart, stock chart. So this is how your stock chart should look. Try to make it look like this. Okay. This. That. It's going to probably go like this. And something like that. I know it looks like a bunch of squiggly lines, but it actually means something. So the first thing I'm looking at right here. So this I can see. See how it's bouncing off the bottom? This is your support line. So the stock price is not going to fall below the support line because it's bounced off of it. So there's some kind of intrinsic value that sets the floor in the stock price. And as you can see, it's hitting this, what is called the resistance. Got it. And then it looked like it was forming another support here. Right here, as you can see that the stock broke out. Break out to upside. So probably some kind of earnings announcement, positive earnings announcement occurred here. What you want to do is write down in here, in this range right here, this is a trading range right here. When you see a stock basically trading, hitting the resistance and hitting the support, it's trading within a range. It's called the trading range. It's also called range bound. It's called accumulation. And it's called consolidation. So the stock price isn't going anywhere. There's not enough information. So the market's just trading it in a range, waiting for information to come to market to cause it to do something. So here it breaks out, as you can see, and then it looks like it's on a run. This is a stock run here. The stock is going up, it's on a run. And then it looks like it's forming another support here. This looks like another resistance. This is what is called the head or the peak. And as you can see, these look like shoulders, right? is a head and shoulders pattern. Is this stock in an upward trend from here? Is this an upward trend? Yeah. So what you can do is you identified upward trend. And then that's the resistance, there's the support. Oh, and it looks like it broke out here a little bit. Looks like this is the new resistance, support. And these here, these are break out to downside. Is this stock in a downward trend? How much time do I have? Usually what you'll have down here on the bottom of the stock chart is you're going to have trading volume. So usually when stocks are trading in a range like this, the volume is very low. And then as the stock starts to move up, the trading volume starts to increase as there's more buy orders. So the volume increases. And then when these go down, the volume goes down. When the volume goes up, when it goes up. Actually, the volume goes up when it sells. And as you can see, like right here, there's major selling. This is like Yahoo stock. If you looked at Yahoo's historical, really high selling volumes. So we want to look at trading volume. If you're using stockcharts.com, this is stockcharts.com. And usually at the top of the graph, there's going to be what is called the RSI. And down at the bottom, there's going to be the MACD. And basically what these are, both of them, are basically trends of momentum. So when the stock price is going up, these are moving up. When the stock price is going up, these are going down. And there's some other lines that are going like this. These basically give you momentum. Okay. These are giving you momentum. These are actually the same down here too. So that's basically the technical analysis. It's very rudimentary. It's a very sophisticated technique, but this is just very simple. So when you look at 3 years of the stock price, and you got a 10-day, on your moving averages, using 10-day, 30-day, and 50-day, I can build a trading system around this. And I can use specifically technical trading methodology to trade my stocks. So using fundamental analysis that we learned in this class, using technical analysis, you can start to trade your own securities and manage your own portfolio. So I'll save that one for Thursday. Is anybody going up? Anybody presenting on Thursday? How long is your presentation? Awesome. You guys are awesome. Okay, cool. Anybody else going on? Okay, 10 minutes? Okay. Thanks, Chelsea. Anybody else? Any questions? Okay, good. If you have any concerns, issues, or anything, let me know. I'll try to post the video.
See you guys later. Yeah, I'll talk to you later.
Thank you. Thank you for being my cinema.